Thank you for coming, all of you, and welcome also to those of you joining us from other parts of the world. Those of us who are here today is Marianne Nässén, Head of the Monetary Policy Department, and me, Barbro Wickman-Parak, Deputy Governor. We will make two short presentations before we open the floor for questions, and I start with a short background to our decision yesterday. And then Marianne gives you a presentation of one of the boxes in our monetary policy report. It deals with the difference between the repo rate and the variable mortgage rates. This has been a topic discussed in Sweden a couple of months at least. Okay, so without further ado, let's get started. So as you already know, yesterday we cut interest rates from 1.25 to from 1.75 to 1.50%, and we also expect it to remain at that level way into next year. The reason is, as you see here on the slide, low growth. We are experiencing low growth today, and we also expect it to be low going forward. At the same time, inflationary pressures are very low and will remain so going ahead. Just a few words about our international outlook. As you all know, the prospects have deteriorated in large part of the euro area, partly as a result of new consolidation measures. And what we also have seen is that the downturn at the end of the year was more pronounced than we had expected. And we expect the prospects for the years ahead, they have been revised downwards since our December forecast. The ECB euro area is the red line here. On the other hand, the growth for US has been revised slightly upwards since December. And looking to other areas around the world, you can see quite decent growth. And if we look at world growth, it doesn't look so bad at all, looking ahead. Let me add to this that since the December meeting, there has been a stabilization on financial markets. Let me illustrate that by this graph showing interest rate on 10-year government bonds. And you can see that the interest rate for Spain and Italy, for instance, has come down quite considerably since December. There are other signs that we have a better situation on the financial markets. For instance, different credit spreads have come down, and activity on corporate bond markets has increased. Of course, ECB loans before Christmas plays a part here, and it has certainly helped to mitigate stress on financial markets. The loans, of course, do not solve the long-term problems, but still a severe liquidity crisis has been averted. Let's now turn to Sweden. As I told you, only minor revisions to our forecast international has been done, but of course composition of growth does matter. In Sweden, our export to about 40% of exports goes to the euro area, and the downturn there have left its mark on exports. The decline has been sharper than we expected. I think that the composition of our exports, big part is machinery, also plays a role here. Going forward, we expect exports to be weak some quarters ahead, but then returning to a more decent pace. Before we move forward, I think it's still important to say that prospects is not all that bad. And let me illustrate by this graph. Early indicators in Sweden and also globally have stabilized in recent months. And if you look carefully, you can see a hook in this graph showing PMI in Sweden and globally. This is just to show that we are not moving towards something like 2008, 2009. And if we look then turn back to Sweden and our growth forecast. For quite a long time, we have foreseen a leveling off in growth in Sweden from high levels in 2010 and 11. And the downturn in exports is the main reason why GDP growth has been revised down for the fourth quarter and also the quarters ahead. But of course, this slide on the exports also has repercussions on domestic demand. Companies are postponing investment and households save more and consume less. But as you can see from this graph, as time goes, growth will pick up and our economy will grow at a more normal pace again. This downturn in growth has so far not made any significant mark on labor markets. But going ahead, we think that lower growth will affect demand for labor and unemployment will increase slightly this year. As you can see from this graph, showing forecast, our current forecast, the red line, and the forecast from December. Given that the slowdown in growth is temporary, the situation in labor markets will improve again later on. Let's turn now to inflation. Low and even falling unit labor cost during recent year, together with appreciation of the krona, have contributed to very low inflationary pressures in our economy. This graph shows CPI and CPIF. That means CPI with interest rate cost, effects of interest rate cost excluded. CPIF is very low, and CPI, the red line, will move lower due to cuts in interest rates. And as you can see from the graph, inflation will stay low the year ahead. But when growth picks up and resource utilization increases, inflation will gradually move higher and be close to 2% at the end of the forecast period, if you look at the CPIF. CPI will, of course, be higher due to hikes in interest rates. Okay. This was a very, very brief background to our decision, and here is the current interest rate path and the interest rate path from December. And of course, our assessment is that this path, new path, will bring back inflation in line with target and also bring resource utilization back to normal. Let me say that this is a very, very low interest rate by historical standards. And real repo rate will be in negative territory during the main part of the forecast period. So now to end up is our usual fan chart. We must of course be aware that things can turn out to be quite different from what we expect. Should the problems in the euro area increase, of course that would have repercussions on growth and on Swedish growth, and then the repo rate should be lowered. On the other hand, should confidence bounce back more swiftly and growth pick up in a more solid way than we expect, then of course this should imply an upward shift in the path. So that's how we look at things. May I just mention also that we have different, as usual, we have different alternative scenarios in our report. And we have combined alternative scenarios for the krona exchange rate with a lower and higher international growth scenario. The experiment gives us a host of different interest rate paths. Let me take two examples. A stronger krona combined with a weaker growth and a zero lower bound would, for instance, call for some kind of quantitative easing. On the other hand, stronger world growth combined with a weaker krona would imply interest hikes, bringing the repo rate rapidly to 3 to 4%. So now I come to Marianne and ask you to make your presentation.
All right. Okay. As Barbara said initially, we have one article about the relationship between the repo rate and various interest rates. And the background is that there's been quite a lot of discussion about the difference between the repo rate and the variable mortgage rate in the last couple of months. We have received lots of questions about this and how we handle this in our forecast, so we thought it would be good to write an article about that and about the difference between the repo rate and interest rates in general. And there are four main points that we try to make in the article and in the report. And the first one is that the repo rate matters for interest rates in the economy. We believe, and we'll have a look at a couple of graphs soon, the repo rate is very important for other interest rates in the Swedish economy. This is pretty obvious, but it needs to be stated again. The repo rate matters. When we change the repo rate, those changes will eventually find themselves transplanted throughout other interest rates in the economy. Turning now to the short-term mortgage rate, they have increased recently, and it's due to two factors. One is increased funding costs. The other is increased margins. Among those, in the increased funding cost part, there are two components. One is the higher repo rate, which matters for short-term mortgage rates, and the other is different types of risk premia. And I'll get back to this on the next slide. So that was the second point. The third point is that we think there's too much focus on the short-term mortgage rate, and we just need to state the obvious, that it's important to look at all types of interest rates that households meet and firms meet. There is not a single interest rate out there which matters for the economy. There's a spectrum of them, and we need to look at them all. And then we end the article by talking in quite general terms about how we take into consideration these different interest rates. And how does it affect the setting of monetary policy? And the answer is in their effects on inflation and resource utilization. So back to the short-term mortgage rate and the fact that those rates have increased in the past few years. This is a decomposition of the variable mortgage rate that you may have seen before. It appears in our financial stability report. The logic behind this decomposition is the following. A bank that extends a loan to a household will need to fund themselves. They issue a long-term bond, a covered bond, perhaps 5-year maturity and fixed rate. Then they enter into an interest rate swap transaction where they convert that fixed payment into a variable rate payment that better matches the income that they receive from the household on the mortgage. That type of transaction is of course not free. They must pay for it. And the cost is the sum of the gray, the yellow, and the red areas. And so the red and the yellow and the gray areas, those are the funding costs of the bank. The remainder, the residual, the blue area, is a combination of many facts. There you have different margins that are used to cover fixed costs, perhaps costs of holding additional liquidity. There is also the question of these are listed mortgage rates from banks and mortgage institutions. There seems to be a premium on the listed rates over the actual ones, so that's part of the blue area. And also the blue area is also covers, it's also a contribution to profits that the banks make on these types of products. Now the yellow and the gray areas have increased in the last few years because of higher risk and liquidity premia. And this has a lot to do with the turmoil in the euro area. So part of this increase we expect is of a temporary nature. And one can expect that those areas will fall back somewhat when the turmoil subsides. But we don't expect the risk premia, liquidity premia, etc., to go back to the levels that we saw prior to the financial crisis. There is a lot of evidence that the premia that you saw before the financial crisis were too low. There was not enough awareness of the risks that were in the financial sector. Also, the blue area can, for various reasons, be expected to fall in the future when, for example, the effects of new regulatory measures are in place and banks become less risky and they need to have less compensation for risk. So in all, we expect the spread between the variable rate and the repo rate to be at this elevated level for a while, but then it will slowly fall, but not back to levels that we saw prior to the financial crisis. Coming back to the issue of we need to look at many rates. The yellow line is the variable mortgage rate, which has been so much discussed lately. There is another mortgage rate which is important for households, namely the one with the fixed mortgage rate. And as you can see, if you go back to the beginning of 2011, that has hardly changed. This is something we cannot overlook when we make our forecasts, because this is important for households. If you combine the green and the yellow and compute some kind of average, you get the blue. I hope you can see the colors. You get the blue line. And so that's the average rate on new mortgages to households, on new loans. If you want to look at the entire stock and compute the average rate on that, you get the purple line, which is the upper line. In this graph, you can see something that I said initially, that the repo rate matters. There's a very, very nice correspondence between the blue and the red line here. So the repo rate matters for mortgage rates. That's very, very clear. These types of rates, the blue line, of course, I mean, these are the types of interest rates that we use when we make our forecasts of disposable income, private consumption, GDP. Just to mention an example, a 1 percentage point increase in the blue line leads roughly to a 1.5 percentage point decrease in disposable income. Roughly half of that effect on private consumption. At the end of the day, about 0.3% on GDP. Not very big effects, as you can hear. But of course, there are other interest rates. It's not just households that matter. We also have firms. And here the orange line, which lies below the blue line, is the average interest rate paid by firms on new bank loans. These are the types of this is the type of information that we look at when we do our investment forecasts. And you can see that those rates are at a lower level than the rates currently facing households. So that was actually it. I'm not going to say anything more about the article, and instead.
Okay, thank you, Marianne. Has been unmuted. Okay, thank you. Well, that was all from us when it comes to presentations, and now you are free to ask questions.
As I said last time, unmuted, that applies to you as well.
Yes.
I have a question regarding the labor market. When reading the monetary policy report, you can see that it seems to be a little bit cautious and uncertain about the weakness in the labor market, how severe it is. Because you mentioned some indicators that point to stabilization in the forward-looking indicators like vacancies, also hiring plans. But on the other hand, you refer to your own company report interview, who shows some weakness. So can you evolve your view about the labor market from here?
Yeah, I think that if you look at what has happened, you can say that this downturn in growth hasn't shown up in the labor market too much still. I mean, at the end of the year, we saw number of persons employed still increasing, hours worked still increasing, and so on and so forth. And of course we have, for instance, companies' plans to hire, and not only our own inquiry, but also from the National Institute of Economic Research. You could see the same. But still, things do not seem to be so serious. And given, if we will have a temporary downturn, I think that we will have a small increase in unemployment. And as you can see, we expect the coming year this must have some effect, but that's all. But of course it's very hard. I know. I mean, we have made our mistakes when it comes to forecasting labor markets before. The upturn that we had after the crisis, we all went wrong and thought it shouldn't be that bounce back as we saw. So we should be humble, but this is our best assessment of the labor market. Okay. More questions?
Okay.
Yeah.
In one of the alternative scenarios, you have a repo rate that is 25 basis points higher and lower,
Yeah.
and you get a different
Yes.
fit to the inflation and unemployment rate. What's your reasoning behind not reducing interest rates by more?
Yeah. I mean, you can say that when you take an interest rate decision, you know that there is a host of other interest rate paths which could be perhaps suitable. But when you do make this decision, I must say that personally for me, this kind of experiment is okay, it's there, but that's not what matters when you sit down and think. You must say to yourself that now I must choose one interest rate which I think is the most suitable for the situation we have. And you know that we have upward, also have upper risk on the scenario and down. So that's, you have the judgment, and the judgment of the majority of the central bank, of the executive board, is that, okay, this is our best assessments of the repo rate going forward.
Do we have anyone on the phone? Do we know? Can you ask?
Hello there.
Hi, maybe I can take a question.
Yeah.
About the other one.
Please go ahead.
All right. So I was wondering, just to go back on this lending spreads. I mean, I know that you said that there's no sort of possible general rule of thumb of how it's going to affect the repo rate path, but given now what we've seen lately, I mean, since last meeting, the increase in the spreads seems to have accelerated, so you'll have sort of more volatility as well as the direction working towards higher spreads. So in a case like that, could you assume that in general, if things are moving more quickly in this space, that is a factor that would have more weight on the rate decision than in normal circumstances where moves are relatively small?
Can I just as a matter of fact, the variable mortgage rate has in fact fallen by about 25 basis points since our last decision. So I think that we need to have that in the back of our heads. But concerning the rest, which is pretty hypothetical, what would happen if something else happened? Maybe Barbara, would you like to answer that?
Yeah, of course. As Marianne said, when we sit down and take our decision, we have a long period of preparation, and there we have all the factors which counts when it comes to the monetary policy decision. Of course, these kinds of things, the different spreads and so on, counts, as Marianne has already said. But you can't say that this spread is the only and the most important factor driving our policy decisions. But of course, should something happen very dramatically, we will take notice of that, and we will consider it when we do our forecast, and then that could have some effects on the conduct of monetary policy. But I think, as Marianne said, that there has been perhaps too much emphasis on this variable when it comes to monetary policy decisions. Yes? Okay.
You still say that the spread is probably not going to come down to the level that it was before. And it would be interesting to hear your reasoning about how this influences the neutral rate.
How this influences
the neutral rate, the rate you should
Okay. That's of course an issue. As I can say, we haven't changed our mind when it comes to the national interest rate. We haven't done it. But as you know, we regularly review this assessment of the natural interest rate. But that's not an issue for us now, so it stays where it has been. Okay. Are you sleeping out there? No more questions? Okay, thank you. Let's close the meeting. Thank you all.
Thank you.